Unfortunately, investing is not always simple. There is so much to learn about, and it's definitely easier to trip up along the way. Whether you've just started or if you've been investing for a few years, mistakes happen. They're almost impossible to avoid. But the best thing about mistakes is that we can learn from them. So, with that in mind, we compiled a few tips that you should use to help you avoid some common investing mistakes. This list is focused on investing mistakes that we have made or we see other people doing when investing with Vanguard's UK website. But some of the tips are also just applicable to investing in general. So, without wasting any more time, let's see if we can iron out some mistakes and hopefully make us all better investors in the process. Let's get into it. So, we're not messing about and we're jumping straight into an important one with number 1 on our list. And it's all related to buying ETFs with Vanguard. Now, this is a tough one, because with the rise of all the free trading apps that have cropped up, we have been used to buying ETFs at any point throughout the day, whenever we want, on demand. Well, on Vanguard's website, we don't actually have that privilege. Well, unless you pay for it. We'll show you what we mean. When you go to buy an ETF on their website, this window pops up, asking if you want to purchase the ETF at the next available price, which is free, or if you want a live price. Now, whilst this seems like a somewhat harmless decision to be made, it is not. In almost all circumstances, you should not buy the ETF at the live price. And here's why. Now look, I get the temptation. Maybe the market's down today, you get excited, you load up Vanguard, and you want the ETF at the price now. But £7.50 is no joke, especially if you're investing relatively small amounts of money. Now, let's say that you want to invest £100. If you get the live price, you're automatically £7.50 down, or 7.5%. That's essentially equivalent to a whole year of stock market returns. If you do this live pricing over and over again every time you buy an ETF, that is going to add up, and it's really going to start eating away at your returns. Unfortunately, when you do buy an ETF at the next available price, it can admittedly be a bit slow. Often the price twice a day. Yes, the market could rise in this time and maybe go up by 1 or 2%, but really, it's not worth stressing about. Over the long term, 1% is going to be insignificant, and it's really not going to stop you from reaching your financial goals. On the other hand, wasting your money on purchasing an ETF for a live price could slow you down, and it will make your financial goals that much harder to reach. So, be patient, and make sure to invest at the next available price. The next tip we're going to cover is also related to investing in ETFs on Vanguard's platform. And again, it's going to catch out beginners if you're used to investing on different platforms. When investing on other apps such as Freetrade or Trading 212, you're allowed to purchase fractional shares. This hasn't always been a thing, but new investors are definitely taking it for granted. This basically means that if a stock or fund was worth £100 for one unit and you wanted to invest £50 into it, you would receive 0.5 shares. But on Vanguard's website, you cannot buy fractional shares. You have to instead buy the shares in whole multiples of the share value. Yeah, I know, it's kind of annoying, but at the same time, it's worth putting up with for the low fees that we get. So, you definitely need to look out for it when investing in funds. Otherwise, you're going to be left over with large amounts of cash sat in your account. Take VUSA, the S&P 500 ETF as an example. It currently has a market price of around £60. So, if you wanted to invest £100 into this fund, you would receive one whole share worth £60, and then you'd have £40 left over as cash into your account. It's worth emphasising that that cash is not invested. It's sat there collecting dust, doing nothing. If your cash isn't working hard for you, then you're losing out. We want our money to make more money, and when it's sat as cash in your account, it's not going to be doing that. To try and avoid this, you can try to invest in multiples of a market price. So for the S&P 500 ETF, for example, you could invest in £60, 120, 180, 240, and so on. Now for some funds, this isn't going to be a huge problem. V3AM, for example, has a market price of around £4, so you're never going to have much cash left over in your account. But for most funds, it's definitely worth looking out for, and you should try to make sure that all of your cash is invested. It's worth mentioning whilst we're talking about it, that index funds on Vanguard don't have this problem. You can invest any amount you like into any fund. This could be a deciding factor when deciding what type of fund you want to invest in on Vanguard, and it's one of the reasons why I prefer index funds. The next tip that we have is a little more portfolio related, but it is still one of the most common mistakes that we see happening on this list. It's all related to diversification, which is the concept of investing in a wide range of stocks from varying geographical locations, market sectors, and even asset classes. If you can spread your investments across all of these different areas, then you're limiting your exposure to any particular asset type or risk. Imagine a portfolio that is filled with stocks that are only from, let's say, Germany. If it happened to be some sort of catastrophic event that ruined the German financial markets, then you'd be screwed. However, a well-diversified portfolio would barely feel the effects of this because the risk was well managed. So we can hopefully agree that diversification is important. But here comes a mistake that most people make. Diversification does not just mean buy one of every fund that is on the website. Time and time again, we see portfolios that are filled with 10 or more types of fund. Now, if that suits you, then fair enough. But at the same time, I know that I'd find that a bit too complex and quite hard to manage. Yes, in a way, if you buy 10 or 20 funds, you are diversified, but probably not in a controlled way. Depending on how much you have allocated to different funds, you could end up massively overweighted in a particular country or market sector, and underweighted in others. Now, I'm not saying that this is always a bad thing, because, maybe you think that a certain country or market sector is going to perform well in the future, so you want to overweight it to, maximize those returns. But if you're overweighting countries or market sectors without even knowing about it, then that could spell trouble. Besides, it's not that easy to track. But luckily, Vanguard have a nice feature on their website that you can use. Once you log in, you can go to your accounts page, click on investments in the left hand side, then click on the Insight tab. It brings up this nice graphic where your portfolio is broken down, showing you top geographical locations, top 10 stocks, and your sector allocation breakdown. So make sure to use this tab to gain a little more control over your portfolio so that you know where and what your money is invested in. The next pitfall that we want you to avoid is also related to fund selection. With so many options available on the platform, it's not easy to build a portfolio that's right for us based on our own personal circumstances. Each of us have different investing goals, risk tolerances, investment horizons, so, a portfolio that works for you might not necessarily work for me, and vice versa. This choice of what to invest in is made a little simpler using the Vanguard LifeStrategy range. These are a range of 5 different funds that have a varying amount of equity and bond exposure, starting with 20% equity, 80% bonds, then 40-60, 60-40, 80-20, and then 100% equity and 0% bonds. Typically, if you have a low tolerance for a risk and a short investment horizon, you want to select a fund that has a low percentage of equity and a higher percentage of bonds. They're going to be less volatile, but then also you might get lower returns. Equally, if you have a high tolerance to risk or a long investment horizon, then you want to select a portfolio that has a higher proportion of equities. It's going to be more risky, but you should also get better returns. So what's the mistake here that people make a lot? It's not choosing a fund that's right for you. Each decision has to be independent. Not based off what your mate said or that random guy on Facebook. You need to base it on your own personal circumstances. One of the most common ones that we see is people wanting to invest in the LifeStrategy 80% or 100% fund to help them achieve their goal that is 2 or 3 years away. Now there is a good chance that LifeStrategy 80 or 100 fund is going to outperform the other funds over that time period, but it's not worth the risk. If it was some sort of market crash or fall in prices, then the LifeStrategy 80 and 100 funds are going to feel it the hardest. The last thing that you want is to be 20% down after 3 years, you reach your financial goal and you have to sell some of your stocks whilst they're down. It'd just be a nightmare. Now I get it. Bonds have had pretty shoddy returns recently, but that doesn't mean that you should just avoid them when the situation actually calls for it. They give you that cushion, and trust me, you don't know you need it until you need it. We have to make sure that we treat risk with respect. Don't let the last 13 years of bull markets fool you into thinking that the markets are always green. We've had it good, trust me. We have to make sure that we're well prepared when things do go sour. But we're not going to waste too much time talking about that today because we've got a video coming up on Vanguard LifeStrategy and using it to invest for the short term. So make sure to look out for that one. The next mistake that is common for new investors probably makes a bigger difference than you think. And it all comes down to investing habits. When investing in index funds on Vanguard's website, the funds are accumulative. This means that the dividends that are normally paid out as cash are actually automatically reinvested into the fund. The ETFs, however, don't allow this feature, so the cash is paid into your account and you can choose to either reinvest it or maybe withdraw it and treat yourself. Now, this surely sounds like a good thing for the ETFs, that bit of flexibility, maybe treat yourself every once in a while. No. Reinvesting dividends has a gigantic effect on your returns, especially over the course of a lifetime. This graph shows the growth of $10,000 invested in the S&P 500 from 1960 to 2017. Just look at the difference in the two end amounts. If you didn't reinvest your dividends, you'd end up with $460,000. But if you did reinvest them, you end up with a massive $2.5 million. It's almost hard to believe that this is true. but at the end of the day, it all comes down to the compound growth of those dividends that are reinvested. Whilst the extra 2% per year in dividends doesn't really sound like much, over the years it starts to add up, and then that 2% compounds and compounds until it becomes massive. I mean, I don't really have to say much more. Surely this graph is enough to make you never want to withdraw your dividends again. You know what to do. Now, this mistake may be the most trivial on this list, but we do have to include it because it may just be the most important one. And if you're a beginner, you might not know about it. The tip is to make sure that you are 100%, absolutely, definitely subscribe to the channel. Nah, I'm just kidding. Investing in a stocks and shares ISA. This is the most important thing that we can do as investors in the UK to make sure that we are getting the edge. So make sure you're doing it. A stocks and shares ISA is a type of investing account that allows you to invest up to £20,000 per year tax-free. This means that any capital gains or dividends that you earn are not taxed when they are earned within a stocks and shares ISA. You should not be investing outside of a stocks and shares ISA in what's known as a GIA or general investing account unless your stocks and shares ISA is maxed out for the year. End of. If you don't do this, you run the risk of paying tax on your dividend payments and then also on your capital gains when you finally go to sell your funds. And trust me, if you're selling your funds in 40 years time, they're going to grow a lot and that capital gain is going to be big and you're going to get taxed big time. There are some mechanics of a stocks and shares ISA that you do need to know about. One being that you can only have one stocks and shares ISA in each tax year. If you already have a stocks and shares ISA with a different provider, then you're going to have to get that transferred over to Vanguard if you want to open one within the same tax year. Last year, I initially had a stocks and shares ISA with Trading 212, but then I transferred it over to Vanguard. The process is pretty simple, you just give them some details and Vanguard does all the work for you. So if you do want to transfer, definitely take advantage of that. Now look, I get it. Investing is not simple, and it can definitely be intimidating for people who are just starting out. There's so much information just being blurted at you from advertising campaigns, YouTube, and your mates, so filtering out the BS is not easy to do. But just remember that investing is a learning process, and that we all make mistakes. But that should not scare you. Ultimately, the earlier we start investing, the better. And making little mistakes like the ones on this list are great opportunities to learn. Hopefully though, you now know a few more things of what to look out for, so you can become an even more successful investor. I'm rooting for you. I'll see you next time, guys.